Hey guys, Frank Cava, experiencedinvestor.com here, and we're still talking about moolah. How do you find money to fund your deals? Okay, so last time we talked about private money and kind of bank money. Let's talk about private money. The first thing that you are going to hear if you're starting down the road to getting into this business is where you can go find people to network with and do things. Inside of those meetings, you are going to find a lot of people who can help. First, RIAs or meetups. We host a local meetup. There's a large RIA in our area. I've been and spoken at many RIAs all around the country. Most of the time there are people who can lend. So if you're new and you're looking to find money, that's a great place to start. So let's start especially with targeting hard money lenders. Hard money is exactly what it sounds like. It's hard money. Now, it's not loan sharking, but it's hard money, okay? They don't usually break your knees or, your ankles if you don't pay, or put you in concrete shoes and drop you into a river. But it's expensive, okay? That's why it's called hard money. The cool thing about hard money is they work with you. They'll set terms that you can actually kind of work through, and if you're new, they'll lend to you. So hard money nowadays in today's environment it usually constitutes one of two things. It has an interest rate, and then there's points. So let's explain both. Let's just say you hear that someone will lend to you at 12 and 2 or 12 and 4. For the sake of our discussion, we'll say 12 and 4. That's a 12% interest rate calculated monthly, and there's 4 points. So what that means is, let's say you go out and buy a house that's worth 150 grand, and you're going to use $100,000 of someone else's money. So you have a $100,000 loan. If you have 4 points, they're going to charge you 4 points or 4 percentage points of that amount, or $4,000. And usually it comes in the form of you writing a check at closing, or they'll wire you in 96 grand and your note will be for 100. One way or the other, it accomplishes the same thing, but that's how points work, okay? On the other side of the ledger is the interest rate. Now, this is very important to pay attention to the details, because interest rates can vary, and what's written in the actual note will determine penalty clauses and things along those lines. But I'm going to go very vanilla here. With the usual interest program, it's usually set for a period of time. So if you have a 6-month period or a 12-month period, it's important to get it done inside of that period of time so you can pay back the money, because there's usually steep penalties. That's number one. Number two, the interest is traditionally non-amortizing. So it's not compounded interest. It's just simple interest. So if you borrow $100,000 for 1 year, you pay 12% on that 1 year. Make sure in the details you understand that. So on a $100,000 deal, you're going to pay 4 points and then 12%. Now, some of you are going to say that's not that bad. Some of you are going to say that sounds really expensive. I think that sounds really expensive. If you're going to be using hard money, it's important that you buy your deal right and you structure the deal in a way that you're still going to be able to make money on the back end. On the next video, what we're going to talk about is how to make sure you structure the deal right so you can still make money, pay it back, and move on to the next one. All right, guys, I'll see you soon.